Hello, everybody, and welcome to the 12th episode of Markets Parlay, in which we look, as you can see here, I was setting up the stream. We look at stocks, we look at investments, and I guess we try to figure out what to do about them, how to build a portfolio. We started with a 10,000 portfolio, now we're moving up to 20,000. It's not like we really doubled our money, it's more like we're deciding to put more money in for people that have joined us in the past. You know what we've been doing. We've been analyzing some stocks. We have a pretty broad selection so far. I think it's like 90 something stocks. We've been narrowing it down. So, I mean, to be honest, we haven't really been done a good job at narrowing it down because we keep coming into names that we're interested in. But we have discarded some of them. You can go back to previous episodes to figure which ones we've selected and which ones we're not so interested in. And at the same time, we've also added more names that we would like to look at. Regardless of the fact, there is something that I've been doing that actually has come to bring some fruits, which is that with the help of some AI, obviously, which is how everything is done these days. With the help of Claude, we built a Russell 2000 little thing here. It's basically, might not be able to check it out. Let's see. Well, it seems like it's not going to give me much trouble, even though I run out of the trial. I'm not going to pay for this. Not a good ROI at the moment. But we're looking at the Russell 2000, which people that are not familiar is basically an index for... let me check if this is going well. All right, why don't I have the chat, though? All right, let me pop it out here. Regardless, we're not going to have too many people anyway for now. But this is a good way to record the video. Oh, well, I don't know if... Are we ever going to get the chat? Interesting. What do I gotta do to make this happen? No chat? Well, the chat is here, but it's not gonna let me pop it out. Interesting. Alright, well, I guess, yeah, this is how we're gonna do it. We're gonna have it here. Yeah, there we go. Sorry about that. So, yeah. So, the Russell 2000 is an index for, I think is the 2,000 smaller companies in the American markets. And you can find something interesting here because it's not names that people are looking at as much. Actually, and look, this is not, it's not really showing much. But we did find a name here that was interesting. It was SM because it was at a really low PE. It was like about 3, right? Let's see if we can... how did I do this thing? I'm trying to... Oh, is it because of the trial thing? Well, that's gonna give us some trouble. Anyway, we can look at it some other way. But you're not gonna let me do it? 1 second. What I'm trying to do is basically rank this by PE. Jeez, this table is big. But I don't know if it is gonna let me do it. Because we found this company was a 3 PE. It's a oil producer, oil drill company in Texas, and they had just acquired another company. They were in the transitioning stages of that, so they were a very well discount, but they were good producers. The main thing was because they were in Texas, in the Permian Basin. Is it the Permian Basin? Is it the Permian Basin? Let me find out. Damn, I just lost the selection here. Permian Basin. Yes. The problem with this basin is basically that... Oh, look at that. Is that there's an overproduction because regulations and stuff make it hard to build new pipelines. So that means that the WTI, the oil that comes from there, it's actually at a cheaper price than it should be because there's just too much supply. Now, I was already buying into the company because of the fact that they're well positioned. They have a basin, they have exploration of drills in different basins, even in a higher one. I forgot the name of it, but like northwest of the Permian Basin, or within it, but to the northwest. And it was well discounted. They were gonna take care of the leverage that they had taken when acquiring the new company, which I forgot the name of it, and they were doing well. But now, because of the Iran war, obviously, that has accelerated significantly. Whatever the case, since Evan might not be able to join us today, we're going to look at a little bit more of that. Now, Yeah, so let me see if we can sort. Yeah, okay, so it's not gonna let me do anything unless I pay for the trial. Interesting. So now let me think. Let me think. Do I want to subscribe to this just to use Excel? Or how about this? Maybe it'll work. Let's try if we open this on Chrome. Let's see. What if, well, we would need another. Because Chrome lets you open Excel files, right? Now the question is, will it let me do the same things I do anyway? So if I grab here, let's see if it lets me do anything with this. Right, we have them. Yeah, got it. Okay. Right. Yeah. Doesn't let me do the same thing, but maybe. Well, we don't need the whole, like, yeah, maybe this one. Let's see. There's definitely an easier way than me just scrolling like this, but I'm a little bit of a noob. Can I make this into a table? Pre-built tables? Smart chips. Well, let's try it out. Pre-built. Convert to table. There we go. All right, there we go. Yeah. Yeah. This does the trick. Again, some of the data here, I mean, all the data here is pretty stale, but it's gonna work. It's gonna, I guess this doesn't need to be that large. Why the percentage here again? Interesting. Whoa. Oh, that's because some of it is collapsed. Yeah, that's fair. I mean, to be honest, yeah, let's just leave it as it is. As long as I can, I just want to be able to read it. Yeah, there we go. Whoa, that's a bit too much, maybe. To equity inside our own. All right. Let's order by this. Sort column, sort A to C. What do you mean? I just want to. I mean, why? Oh, it's already. Okay. It is already sorted by that. So the one that we were talking about, yeah, here it is, SM Energy, right? Now, the reason why we were more interested is because, good profit margin, operating margin, debt to equity was low. It has gone up since the acquisition, by the way. Revenue growth was good. So that's why we looked at it. And it turned out to be advantageous, although again with the caveat of being affected by the Iran war. Okay, so let's keep going through this because I find this more interesting than looking. I mean, the other, that's just to give some context here. And again, I don't know if we'll be able to look at it like from here. Yeah, exactly. So I guess we can just, since it's going to keep giving me trouble, let's also open it from here. So in here, let me, this. Da, 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 da. All right. So yeah, these are the other ones that we had selected. There were ones, for example, Coherent is one that Evan apparently likes more because they are expert in the field, which I think was laser, like the use of laser for making semiconductors and microchips. And yeah, but the valuation there worries me a little bit. I think it was like over 300 or maybe not so much, but 200 P, maybe a little bit lower. I don't know. Don't quote me on that. Then Caspi was interesting too. It was like a social media, it was like banking actually, financial institution, like online finance, online banking in it was a country, Kazakhstan, I believe, like some country in the Caspian Sea. That's why the name. There were other ones that were interesting from, and this was a selection that we found from this guy, Mispriced Assets in TikTok. There were other ones too that we've been just interested in different sectors, right? So we did look, for example, at PayPal, which unfortunately, because of the transition to a new CEO, was like heavily depressed. Like I think it was like 20 to 25% drop after earnings. It was like for the financial reporting for the year. And even though the earnings were like kind of in line of what we expected, which is nothing flashy, just kind of doing well in this transition, but because this acceleration in growth was not happening, they basically kicked the CEO and put a new one. The guy coming from HP, the guy that kind of did the turnaround and the evolution of HP to become like a more modern company. So I guess they're trying to do the same thing with PayPal here. So that's one that now I'm a major shareholder on because of I bought into it during earnings, and now because of the depression in the stock, I'm gonna be holding for a little bit longer. Than I mean, to be honest, it would have just been a better entry point in the sense that it would have been nicer for it not to drop. But it was a stock that I wanted to own in the long term because even now it makes less sense. Like I bought more of it when it dropped because it's like a 8p or something like that for a company that is like tech based with like tech margins, and it's one of the major ones in financial, in like online financing, and they're doing well. They're not growing in a flashy or like an outrageous way, but definitely doesn't justify such a low PE. So that's why it's definitely still a buying opportunity, in my opinion. We'll see how the turnaround works, but it kind of get worse at such a low price. Definitely, it's a good investment, in my opinion. Whatever the case, let's keep exploring these companies that are much more the lower end of things. So we have here again another low PE at 3. We have a price to book of 1, which is more attractive than SM. This is an information technology, electronic components. Return on invested capital is good. Operating margin, you see, now this is where things get a little bit more worrisome. We can look at it a little bit more in depth, but that's not a great thing to see. An operating margin that is so heavily negative. But again, if it's like, imagine that it's all cents, right? These margins are like maybe they're losing money, but by cents, it makes these numbers look a little bit more dramatic than they actually end up being because of the small amount of profit or loss, in this case of cents. Debt to equity is low. That's great. Profit margin, you see, this is something that we gotta kind of study, because why is the operating margin so low but the profit margin is so high? This has to be something that like the very like maybe cents on it. Insider ownership, revenue growth, you see now the revenue growth contracting at 50%. That doesn't look very good, but then the EPS is growing, so we're gonna let's give it a look. But it doesn't look like it's gonna be something too interesting. So let's see here. Let's go to Schwab, which is which will give us a little bit of an idea on what we're looking at here. Let's see here. I think it was Neon. Yeah, that's it. So these people make, together with his subsidiaries, develops optical sensing solutions for contactless touch and gesture sensing. Right. So they basically make touch screens, right? South Korea, the United States, internationally also offers software solutions for machine perception to detect and track persons and objects in video streams. So also for optic sensors, I suppose. Oh, well, I mean, it says optical sensing solutions for contactless touch. Huh. Oh, so it's not touchscreens. But it says also touch and gesture sensing, but it seems, so it says contactless touch. Huh. Optical sensing. Maybe things like glasses, how they figure it out. Like, how the glasses, like the Apple ones, they detect how you're interacting with it, so as providing non-recurring engineering service related to application development. All right, let's see the numbers, because a company with this, if the numbers are not looking good, I'm not going to look that much more into it. So, I mean, the price is heavily depressed, but at some point, they were a darling in the market to some extent. So, why the crazy downturn here? Also, why are the earnings not being reported Like, why are they just not third quarter of 25, second quarter of 25? Are they about to report? I suppose, right? Fourth quarter of where's fourth quarter? Is this fourth quarter? March 21st. So they are about to report. Let's check it out. Let's see. Yeah, bruh. I mean, this looks terrible. Revenue just contracting over and over. Operating expenses. Operating income. Income before tax. Yeah, it's not good. Yeah, it's just not good. Yeah, we're not gonna look more into this one. I don't know what exactly it is that is making the revenue grow, like the contracting so much, but I'm not interested in finding out. Calm. Oh yeah, we are a shareholder of these guys. Again, this is not reflective because the earnings have actually depressed significantly because they're just a commodity. They sell eggs, right? So we looked into this in a previous show. I don't remember what episode it was, and it's a great company, you know. To be honest, even though like now it's more of a, if we look at like more recent earnings, more like a 10p instead of a 3p. Same thing with the dividend yield. I mean, which again, I mean, this is actually closer maybe to what it actually is. But it's, if you look at it in like, I think it's here. If I just search it, it's close to like 10% or something like that. I don't know if they've already updated it. But the thing is, that is not a fair assessment because they always give a third of their income into earnings, of their earnings into dividends. You see, here it is. But because those earnings are going to be depressed because of the price of eggs depressing, it's not reflective. It's just kind of it's lagging behind what the number shows. Okay. Again, great company. We already looked at it. Core Medics, Healthcare, Biotech, P of 3, price to book of 1.6. Good. Well, sort of. I mean, it's not amazing. Again, this is the great one. I mean, I love it. I mean, I love, you know, it's been very lucky buy, but it's great because, you know, they provide a commodity. It's close to home in the sense of close to the US. They don't have to worry about any exports and things. The main thing is the fact that they're in a basin that is oversupplied, you know. But because it's at a cheaper price, we're gonna be fine. Operating margin great, debt to equity low, or pretty much non-existent. Great profit margin. We don't care that much about that part. And revenue growth, wow. Well, this is definitely interesting. CRMD. Let's see. What are these people about? Core Medics. Okay. They just missed earnings by a lot. We're going to see what that's about, but let's see. Or maybe not. Biopharmaceutical company focuses on developing and commercializing therapeutic products for life-threatening diseases and conditions. Product candidate is DefenCath, an antimicrobial catheter lock solution to reduce the incidence of catheter-related bloodstream infections. So they make catheters. I mean, they probably make more things, but it seems like, yeah, for equipment that is related, like catheters, it seems to be their main thing to avoid infections in that respect. Okay, so they provide equipment for hospitals, I suppose, is the main thing, right? So healthcare, interesting, especially in the sense like this is something that more and more of the older people need that type of equipment in a healthcare environment. Now let's see. Let's look at this. What is this? Wow, yeah. Quarter 3 of 25 was an incredible beat. And I suppose that was reflected in the price. Well, not really. Interesting. This might be interesting. Look at this. We're going to have to do a little bit more of an average, but I mean, in all fairness, what the I mean, they're such a small company. What is the market cap in these guys? 500 million. Right. What is this? Why? Why the huge increase in revenue? You know what I'm saying? Operating expenses is just like, yeah, that's a normal trend. But then suddenly they were making any money. We're gonna look a little bit deeper into this, but before I ask the AI to like give me a rundown of why these people have just started making money basically. This is great margin too for a company that makes Wait, what? Oh, this is expenses. Oh, okay, so they're losing money. I was gonna say how they have a higher outcome, labor-related expense. Yeah, so it must have been that they were investigating or developing a solution, and they just started selling it. Interesting too that the cost of revenue, the cost of the equipment itself. So interesting. Do they provide the services around the equipment? Because how can the cost of revenue be so low for equipment? Research and development. Yeah. They must have developed the product because look at that. The research and development has gone down, but every other expense has gone up. So they must have spent all the time figuring out what it is that they're gonna sell, and now they're selling it. And they acquired some debt the year before, to I guess accelerate that going into market thing. Again, still, not making money. But they were losing money significantly, I suppose, when they were researching. Now they're coming up. Why there's a dip here before they start making money? What is this coming from? Right, when they start, is it this? Selling general administrative? Plus still doing some research. With no revenue, obviously, but I was just trying to figure out why it went from losing 30 million to losing 46. Basic primary weighted average shares. Now, did they acquire any debt? I assume they did. They had cash. They continue to have a good amount of cash. Short-term investments, they've reduced that. Cash and short-term also reduced. The trade accounts receivable. Yeah, again, they must have just started selling. Total inventory, right? They didn't have any inventory before that. Yeah, they definitely got ready the year before. I guess we gotta look at the quarters at this point because it's something that is very recent. Property, plant, and equipment. Okay, they already had it ready, but they just weren't selling. Accumulated depreciation. Well, yeah, that's just the usual thing for them having the factories for a while. Intangibles here. But maybe they register the IP here for whatever they develop. Restricted cash, total assets. Okay. Now, accounts payable. Well, this is them getting ready for inventory. Accrued expenses, again, now that they're producing things. Total debt, look at that. Well, they didn't really have any debt, actually, and they still don't have, which is great to see. But it says here total, because of the current liabilities of accrued expenses. Okay, that's irrelevant. Yeah, so look at that. Equity is steadily going up. Now the question is, okay, they've just been having a lot of retained losses, which again, if they've been developing the product for a while, it would add up that the retained losses, they gotta kind of bring it back up. But I wonder the additional paid-in capital. So they've just been investing in the company to counteract just the loss. Well, if this is actually coming into maturity, this could be an interesting thing to look at. Let's see their income on a quarterly basis. Right. Actually, yeah, this is... So we said on an annual basis, they went from ending on December 2023. Wait. Oh, because they haven't reported. Oh, they about to report 2025. Wow, wait a second. But they made a lot in this quarter. So they're gonna report crazy. I mean crazy. They're gonna go from 43 million to way more. Way more. Like 280 to 180. 200, let's say. I mean, even if I add another 100, 300, 480. With expenses of this, the income is steadily going up. So yeah, even net income is positive. So then why did they miss earnings? Was it just analysts were expecting more, I assume? Because EPS here is good. It's growing significantly. All right, let's yeah, this is definitely calling for some more questions. Let's see their cash flow. Although I would assume they don't really have crazy cash flow. Well, in line with income, I suppose. Amortization, big numbers like this, non-cash items, accounts receivable, going down. If they have accounts receivable going down, that would mean... Wait, what is their accounts receivable in the balance sheet? I always get this mixed up. Accounts receivable growth. Right, so, right, because they're not getting paid in cash. Yeah, exactly. So this is just discounting the fact that a lot of the money that is coming in through income is not in cash. I gotta go to the bathroom. Be right back. Oh, I love a freshly washed jacket. It smells so good. All right. So accounts receivable. Right. So it all looks like they just started making business. I know I keep saying that, and the moment we are starting the talking with the AI, it's gonna make more sense. But I guess I just want to see what the numbers are saying before I start asking questions. Oh, excuse me. Let's see. Total cash from operations. Good. Operating cash is healthy and growing. Capital expenditures. Well, even you see, this is they're okay. They're going from nothing to 540,000. Acquisition of business. So oh wow, 310 million. Wait, is that reflected here? I assume. Well, not here, but here. 300. Oh, so this is where it all got goodwill. But for 310, the goodwill to only be 17 million means that most of what they acquired was just. Oh, okay. I was gonna say it was property and stuff, but no, it's actually maybe IP or something. Interesting. Wait, this doesn't add up though. I mean, it does add up, but I'm saying, is this the reason why they're producing revenue? Or were they producing revenue? They seem to have been producing revenue, yeah, even before that. Right, but there's a significant uptake. But if they just acquired the company, it wouldn't really make sense that would be reflected in the revenue. So they must be growing revenue regardless of the fact that they just acquired whatever it is. I mean, they did do it the quarter before. Interesting. So if they did it the quarter before, in quarter 3 of 25, and that's where the jump in revenue comes, like significant. So then it may be that because of that acquisition, they started making the revenue. Now, they haven't really acquired debt with that acquisition. So I wonder, where the hell did the financing for that come from? They had 159 in cash. Then they spent it. But how did they finance it? You know what I'm saying? Because if they had 190 million and they spent 300 million, but they didn't acquire any long-term debt. Oh, never mind. There it is. They spent... Wait, how did I... Oh, because on a quarterly basis, I was looking at an annual. And I was like, well, they don't have any debt. They don't have debt yet. Yeah, exactly. Oh, well, there it is. So, I guess I didn't see that at first. I was looking at something else. So, they acquired 145 million in debt. And they spent... Does it show here? No, it doesn't show because it was interim. And then the cash went up again. So, I guess maybe the company they acquired had a bunch of debt. Because if we see here, when they acquired the company, their cash and short-term investments went from 190 to 56, which means they spent about 140 million. Plus another 140 that they got from the debt seas, means what? 140, 300 and something. 300 and something is where their goodwill would be coming from, which we also have here, don't we? Yeah. Well, not the goodwill, but the whole thing. Well, you see what I mean? It is still more. But, well, if you value the company, if they bought it at a discount of what they assume the company to be, right, they pay 300 million for a company that is worth 400 and something, the goodwill. But then why would they put goodwill? Goodwill is the price you pay above the value of the assets. So then they must have paid more. Again, I guess at this point we really do have to go into looking at what it is they bought. Right. But I mean, if they put it here like that, it must have been that that's the money they spent. Unless they also gave some shares, you know? That could be 310 in cash, the rest in shares. Right. Purchase of investments, other investment cash flow, financing cash flows. Okay. Throw cash from finance and long-term debt again. This is where it comes. Issue retirement of debt. Also, they might have issued some shares. Sell. No, I mean, they did sell. I'm trying to understand. They weren't selling that much stock, and then they went up like 19 million. Yeah. Options. Yeah, so that came from financing, 240 million plus the 130 or 140 something that they had spent. That would be 240, 140. That's 340, 380. Yeah, that's closer to the price. Plus the goodwill. 310 plus the goodwill. All right, we'll see. I think it's time. Yeah, let's get this on the guys. CRMD. Commercial therapeutic products for life-threatening diseases. Let's check their website too. Look at her. Focus on developing and commercializing therapeutic products for life-threatening diseases and conditions. Our products. Well, you got a bunch of things. Okay, before we get into that though, yeah, let's just comment. This is how we go about this. All right. Fuck, I forgot the ticker. No. Where do we have this here? CRMD. Cormedics. Focus on developing and commercializing therapeutic products for life-threatening infectious and inflammatory disease, led by CEO and Chairman Joseph Tordisco. The company's flagship product, DefenCath, the first and only FDA-approved antimicrobial catheter lock solution in the United States, has driven exceptional commercial momentum, with full year 2025 reaching revenue approximately 310 million, representing 1,600 growth year over year, underpinned by high gross margin exceeding. But yeah, that's why I'm confused how, if they're selling equipment, they have such a crazy good margin. Significantly expanding its commercial footprint through the acquisition of Melinta Therapeutics, adding a diversified portfolio of hospital-based anti-infective products, including Rezayo. Okay, so if those are the products that they got from the acquisition, Rezayo, Vamobir, Orbactive, and Minocin, then their main thing is this, DefenCath. Right. DefenCath. Protect the central line. First and only FDA-approved catheter lock solution. To reduce the incidence of infection through the catheter. I mean, I do like this kind of thing. Because a product that would be used significantly regardless, because intravenous delivery of, drugs or anything like that, even for the transfusion of blood and stuff. Look at this. 5 bullish from a price on 13 to 22, and this is a 6. I'm liking this, baby. We gotta look at why the price is depressed. Anyway, pro forma revenue to approximately 400 million. Wait, is this what we just calculated? Bringing pro forma 2025 revenues to 400 million. Right, because that's kind of what we calculated here when we were looking at the numbers. In that, you got 120, 100. Wait a second. We're already there. So they did report for the year. Why is it not here? But it is. Oh, so 400 million is for 2026? Why does it say 2025? Look at the same one. Why does it seem like it's always showing different Am I not looking at things right the first time? I suppose. 300 million. Performance 400. We don't have any other quarters yet. The next quarter that they're gonna report is quarter. What would it be? Quarter one of 26. And probably significantly higher. I mean, probably maybe like what 140, 100 something like that. Anyway, let's see. Looking ahead, the company is advancing phase 3 clinical studies for deaf and calf in adult total parental nutrition patients and pediatric hemodialysis patients, while also pursuing a phase 3 prophylaxis trial for Rezayo in allogenic transplant patients. I mean, the fact that they're both in phase 3, with the fact that they're the only FDA approved catheter, like, antimicrobial catheter, that looks promising. Multi-billion-dollar addressable market. Yeah, I mean, that makes sense. I mean, there's a lot of need for something like that, I would imagine. Why is the price? We're gonna have to ask the A for that. Even though they did get this, why is the price so depressed then? And how did they do on earnings last? Quarter 4, 2035. They missed earnings, right? Because the expectation was that. The expectation was 86 on much lower revenue. And this is quarter 4, 25. So in quarter 4, 25, they were expecting 100 million, but 88 cents of profit. And that did not translate. So actually, they weren't expecting much growth from the previous quarter, which, I mean, okay, fair. But why? Why did they not get the earnings these people were expecting? What is the big expense item here? Because if they were looking at this quarter, which is what I assume the analysts were looking at. Oh, there it is. Selling. Right, they didn't expect them. Right, that's probably it. 20 million. They really ramped up selling, general, and administrative. Even though they reduced labor and related expenses by about this seems like an accounting thing. Look at this. The labor and related expenses go down, but selling, general, and administrative goes up. So it doesn't really move the needle here. If we take into account how the revenue has grown, this didn't really grow that much. Like, we can't even do the revenue. Do I have the calculator key in here? No, I guess not anymore. That was the other keyboard. I'll do it on my phone. Let's see. I mean, it's like what, 129 divided by 104. It's just like a 24% growth, and this is 69 divided by 53. It's a 30%. Oh, so yeah, it grows in line. It grows in line with revenue. So that's not surprising in that respect. Again, if these people were expecting, why do you give it to me in EPS though? Okay, let's see what happens here. Operating income, it grows in line. Yeah, as we can see here, it grows in line. Maybe a little bit lower than the growth in revenue, but pretty much in line. Yeah. The interest expense, again, all is in line. So why were they expecting? Oh, what is this? Provision for income taxes. Well, that's absurd then. In the sense, like, if that's why they missed EPS. Yeah, because look at this. Yeah, they're paying taxes that they didn't pay in the quarter before. Big deal. Yeah, big deal. This is not a worrisome thing at all. If we normalize this, like, if we spread these taxes around, this falls down to, like, I don't know. I mean, yeah, you could bring it down to, let's say, that they paid 20 million there. So that would be 30, and then we bring the 30 here, and it's another 10. Or let's say 15, right? So if they only take 15 here, this 109 minus whatever, 40. So, and then the other one will be 42 minus whatever the amount is there. Well, instead of 42, it will be 15, so that brings 14. 42 minus 10, 32. 27 plus 14, 37. Yeah, 40 something. Which again, it is lower, but it's like, yeah, that is the only difference between these two. Income before taxes is the same, maybe not growing as much, but that's because interest income is a little bit lower. But so is interest expense higher. So interest expense, well, yeah, it's higher with interest income being lower. Yeah. And then we get the EPS. Right, it says 15 cents. But here it says 61 cents. That because diluted? No. What the hell's going on? Is it because this is GAAP? And the one that they're reporting there is non-GAAP? That it? Yeah, adjusted. Yeah. Alright, fair. But again, not a significant issue here at all. I don't see it. Interest expense supplemental. This comes from here. Normalized income. Yeah, but this is alright. Again, I don't know. Was the quarter before? Right, a huge surprise because of the taxes. A miss on revenues, though. Quarter 3. Wait a second, though. Revenue of 120. Wait. What's going on here? What is the data stale? I don't get it. 129 is quarter 4 of 25. But here it shows up at... Oh, no, okay. This is the actual. Yeah, 104. That's not right. Oh, quarter 3. Okay. I'm tripping. So they were expecting 127 in quarter 3 and they did 104. Right, because that I guess was the big ramp up. So they missed there. Then they were expecting a lower one, 100, because it's like kind of playing catch up. And they do 180 and 28, so that's great. But then the earnings they missed, and here because of the taxes, that's the only reason they beat here. Reported quarter 4 25 net revenue of 128 million, with Def and Cath contributing 91 million, and the newly acquired Melina portfolio 37.4. Pro forma revenue was 401. What do you mean pro forma? That is not right, though. That's not 400 on. For 20, it's 312. So what do you mean? Achieving peak sales of just under 260 million. Is that where that comes from? Right. Well, confusing. The company affirmed 2026 financial guidance of 300 to 320 million revenue and 100 and 125 million adjusted EBITDA. We're also providing 2027 different Cath guidance of 100 to 125. Yeah, that's not a crazy growth, but I mean, 90 to 125 is, I guess, significant. Is what? Yeah, I mean, that is a 30% growth. Based on existing patient utilization, estimated net selling prices, excluding potential upside from new customers. Okay. Managed care contracts. Def and Cath reimbursement will transition from buy and bill to bundled add-on. With expected price erosion in quarter 3 and quarter 4 26, but the company anticipates meaningful increase in Medicare provider reimbursement. 2027 that should translate to higher net selling prices. Phase 3 RESPECT study for Versaio in prophylaxis and invasive fungal infections. Completed enrollment with database lock expected later this month and top-line data anticipated in quarter 226. The company estimates the market opportunity for Versaio is approximately 2.5 billion across both potential indications. The company ended quarter 4 25 with 148.5 million in cash and short-term investments, with strong operating cash flow of almost 100 million in the quarter. Share repurchase program are successfully integrated. What is the share repurchase program? All right. I gotta go to the bathroom again. Sorry, guys. This one's gonna take a little bit longer. I'll be right back. All right. Sorry about that. Shit. Okay. Hit my elbow there. Yeah. So let's keep going with these core medics. They look interesting. I'm like, I'm wary of it because I'm like, why are we finding just a few lines below another country that looks interesting? Okay, let's see. First of all, we got a couple of questions. The first thing The fuck is this? Oh, it's gone the other way. I'm like, hey. Oh wait, before. Let's see, because they usually have a good summary at the bottom of, bull versus bull, bear. Good. So what is this? Buy from Needham. From 15. Okay. This is probably because the downside in the stock from 18 to 13. I mean, this doesn't worry me that much because I know sell side lowers the price sometimes just to get in line with market dynamics. But even if it was for a legitimate reason, as you can see here, the upside is still 100 for all of these. Worcester is unanimously bullish. 100% of the 5 covering analysts rating the stock a buy. A rare strong buy consensus. The average price target sits at 15.20 with a median of 14, implying meaningful upside from recent levels, while the range spans from low 13 to high 22. Notably, several firms trimmed their price targets in recent months, while Needham followed suit with a modest trim. Right, but again, look where we're trimming from. 22, 18, 20 from Needham. Oh, but this is from before, right? Yeah. Yeah, it doesn't bother me much. RBC. This target reduction appeared tied to CRMD's 9% post-earnings sell-off following. Yeah, exactly. So, I'm not saying I'm an expert or anything on this stuff, but I remember when I was working on sell-side research, it's a lot of that. You know what I'm saying? You cannot have a price target that's too far from the current price, because then you look like you're delusional, even if you still believe in the stock, even if the story hasn't changed. If the market is repricing on a lower end, you have to do something about it. It has to look like you're adjusting expectations, which again, it makes sense too. It's like, you cannot tell investors, oh, the stock is going to go up so much more, so you can tell them it's going to go up this much more, and then you adjust the price later on and bring it back up. Okay, so despite the company reaffirming revenue guidance of 300 to 320 million, so the results early March, despite the company, it's suggesting analysts view the pullback as a recalibration rather than a fundamental concern. The unwavering buy ratings across the board, even amid downward target revisions, indicate that the street sees the recent weakness as a potential entry opportunity rather than a reason to turn cautious. Yeah, that's what it looks like to me as well. But let's look a little bit into this stuff. DefenCat reimbursement transition, right? This is the part that, again, we're not that familiar. We just spent, 30 minutes on this stuff so far. Management's affirmed 2026 DefenCat guidance of 150 to 170 million. Right, the revenue coming just from that. And 2027 guidance of 100 to 100. Interesting. Why would it be lower for 2027? Confidence in sustained revenue even after the TDAPA to add-on adjustment shift. The company's 93% gross margin and reaffirmed full year 2026 revenue guidance supports a resilient pricing outlook. The bearish view. Leerink Partners cut its price target from 15 again, citing near-term pricing headwinds. Right, so what is this TDAPA? We got asked about the effective July 1st, 2026. Revenue concentration is expected to be front-loaded. Right, because then they'll have to adjust with significant price erosion anticipated quarter for 26, raising concerns about the durability of DefenCat's revenue contribution. Revenue growth trajectory and margin expansion assumptions. The consensus analyst narrative projects revenue growing at 52.8% per year, with profit margins rising. So, okay, this just looks very good. Reaching an estimated 433 million in revenue and 244.7 million in earnings by 2028. That's insane. I mean, it's insane. I don't know. If we look at if they're saying income is going to be 240 million, and right now, where are we at? 160. I mean, the PE becomes even more significant at that point. I mean, yeah, it's looking forward 2 years, but it's like this. Yeah, I don't see why that would be, even with a price pressure like what they're talking about. It cannot be that high of a price pressure. Well, this camera should be a little bit more to the right, shouldn't it? Just a little bit. Okay. So, no. Let's see. I got distracted by that stupid stuff. Company's already impressive. net profit margin, and yeah, 52% net profit margin for a biotech company produces equipment. I mean, I'm still, I don't quite get how they have a gross margin of 90 something percent, but 93. Underpin this optimistic growth path. Cautious analysts project a far more modest annual revenue growth rate of just 12.3. With margins expected to compress rather than expand, the uneven quarterly revenue pattern within 2025 raises questions about how much of the recent revenue jump is recurring versus one-off, casting doubt on aggressive. I don't quite see, again, I don't know the product that well, but it's like, why would it be one-off if they're the only FDA approved solution? Bullshit. With stock valuation and near-term price recovery potential, with 7 analysts maintaining a buy consensus, an average one-year price target of 15 to 19, representing upside of 100% from current levels, firms including Truist, Needham, RBC, and Leerink argue the stock is deeply undervalued relative to its earning power and pipeline catalysts. The stock has fallen 63% from its 52-week high and continues to face volatility, insider selling, and significant shareholder dilution. Holds a negative evaluation, flagging the stock is a sell candidate with very high risk due to extreme price volatility and weak near-term technical signals. Again, okay, so this would be something that maybe I wouldn't want to buy options on, but just buy the stock. Because we're going to have volatility. I mean, again, unless I think the near-term it's going to... But why? Why the sell-off? Okay, so we have a couple of questions. I guess we want to understand... First of all, what was the dynamic that got them to start making revenue before anything else? Second of all, what is this transition thing, this TDAPA to add on? And third, why is the market not reacting positively? You know? This is when they started making revenue, I suppose, 2024. Is not what they said? What we see here? Yeah, let's see on a quarterly basis. I mean... There's 43 million on an annual basis. Most of it was quarter one. Well, sorry. Most of it was quarter four 24. Yeah, do we have these guys on ROIC? What's the ticker? CRMD. All right, let's see. Maybe we get lucky here. Oh, they do have something. Again, we kind of look at quarters. I forgot. Again, why, man? I don't... Yeah, well, they don't even give me 25. I don't care about this then. Alright, yeah, let's just ask. Okay. Hey, so first of all, I'm trying... Right, so yeah, so interesting though that the company was public before then though. Was finally launched before it was essentially a pre-commercial R&D stage biotech living off capital raises rather than sales. What the business was before 2024, CRMD spent years as a development stage biopharma focused on getting DefenCath to reduce bloodstream infections and hemodialysis patients through clinical trials and FDA review. It had no approved products and therefore essentially no recurring product revenue or funding. Okay, so it is kind of what we guessed. The core asset and value proposition were always DefenCath. The company's business pre-2024 was pipeline development plus regulatory de-risking, not commercial operations. So did the stock price, though, move in accordance with that? Like if we check... Yeah, right. Yeah, right. So they were like a $3 stock until they, boom, got approved. Started going up, and then it's just a roller coaster. But then, yeah, why we're back at these levels? I mean, I'm gonna look at it just cause, but why? They don't really provide much good analysis here, but oh, the average price volatility, price volume. It's like, yeah, it's all technical. I don't even know. Yeah, I mean, I think this is all just made by some AI. You know, not even AI. It could be called these days, this day and age. And this one, all the hype. Yeah, but it's like, you see how it's like, even with Yeah. Yeah, no, but I mean, this will point to a buy regardless because the volatility is high on a stock that is at a low point with no real fundamental reason. So that would mean that the next catalyst has to be going up. Uh, the downside is limited at this point. Key catalysts that unlock revenue in 2024. The revenue inflections is almost entirely tied to regulatory and commercial milestones. FDA approval. DefenCath received NDA approval under LPAD pathway the 15th of November 2023, which legally enabled marketing in the indicated hemodialysis population. Inpatient launch, hospital setting. Commercial launch in the U.S. inpatient setting started on 15th of April 2024, generating the first U.S. DefenCath sales and the first reported product revenue. Outpatient reimbursement and launch. Multi-year supply commercial agreements. How proved and sustainable these revenue streams? Evidence the new revenue is real and gaining traction. First commercial quarters. CorMedix reported its first US DefenCath revenue in quarter 24, then 11 million, then 31, with full year 2024 revenue of 43 to 45. Profitability crossover. Management stated they achieved at least break even by year end 2024. On a run rate basis, indicating DefenCath sales were sufficient to cover operating expenses at that point. Signals on sustainability and durability. Structural medical need. DefenCath is positioned to prevent catheter-related bloodstream infections in chronic hemodialysis patients with central venous catheters, to population with an ongoing infection risk and recurring catheter lock use, which structurally support repeat high-frequency utilization per patient. Reimbursement in place. CMS reimbursement for outpatient use starting July 2024 removes a major barrier to adoption and makes usage economically viable for dialysis organizations, which is critical for revenue durability. Expanding customer base. The company continues to announce implementation and expansion with large dialysis organizations, with guidance increased tied to additional clinics and higher patient coverage, suggesting growing and diversifying customer demand. For guidance, management and external commentary project significant additional growth. Main risks: concentration in one main product and one core indication. And how does their DefenCath product compare to competitors? Do they have a good amount there? Clinically and economically stronger than plain heparin and basic citrate logs, but its mode is moderate. It has unique FDA-approved torelidine heparin combo and strong data, yet it competes in a crowded, price-sensitive space with off-label and cheaper alternatives. Composition MOA, given both anticoagulant and broad non-specific antimicrobial activity. Efficacy versus heparin. Reduce risk by 71%. From 0.46 to 0.13 events per 1,000 catheter days with a highly significant p-value. Nice. I mean, that's a very low p-value for statistics. Economic value. A 2025 health economics model found. DefenCath prevents. Nice. Main competitive types: heparin logs, traditional standard of care, cheap, familiar, but clearly inferior. Citrate-only logs, sodium citrate, widely used, safer than high-dose heparin for bleeding. Some data showing better performance than heparin on catheter function and maybe infection, but antimicrobial effect is weaker and clinical evidence is mixed. Other torelidine-based logs in Europe have long clinical use. A trial site in 2023 review showed torelidine-based logs have lower CRBSI rates than citrate alone. Right, this is in line with what their solution does. Institutional cocktails. Many centers use their own off-label log recipes. Right. So I guess the main thing with them is that they package that whole solution into one product, right? Clinical comparison: anticoagulant, heparin, antimicrobial torelidine. Right, so it's a mix of things. in which, yeah, so we have heparin and citrate. RCT shows better than citrate. It's kind of what they have too. Yeah, right. The main thing is that this is approved by the FDA. Regulatory and label position. Defenca is the first and only FDA approved. Data package. Lock it 100 plus. Follow-up publications and monographs give robust RCT and health economics evidence. Payers and large dialysis organizations value this when standardized protocols. Like they have good data backing the efficacy of these solutions. Real-world adoption studies post-marketing, large-scale observational work. Where the mode is weaker, technology defensibility, tauruladine-based locks are not unique to CRMD globally. Similar combinations exist in Europe, so the scientific concern is not properly, in an absolute sense, right. But the regulatory issue, especially in America, being the biggest healthcare market, is great. Now the question is, are there other companies trying to get this type of product? A price-sensitive, protocol-driven market. Dialysis chains can favor cheaper citrate and institutional cocktails if they believe the cost-benefit is comparable, especially outside the narrow-labeled population in regions where DefenCath is not reimbursed. That's why they were talking about Medicare, right? Future competition. Another company could, in time, pursue U.S. approval. Right, there it is. Eroding the differentiation. NetView. In the U.S. adult chronic hemodialysis CVC segment, DefenCath currently enjoys a solid regulatory evidence and contracting mode versus on-label competitors, especially generic heparin. The mode is narrower than when you consider off-label citrate, institutional mixes, and non-U.S. markets, and it will depend heavily on ongoing real-world data, economic performance, ability to lock in long-term contracts. Yeah, that makes sense. All right, let's see. Are there other companies pursuing FDA approval for a product that would compete with DefenCath? Based on what's visible today, only approved antimicrobial, right? Evidence of other companies pursuing approval. Literature and clinicaltrials.gov show historical and exploratory work on antimicrobial locks, B-log, and other, but these are mostly older or outside the current NDA pipeline, and none show evidence of an active named NDA close to approval. Risk focuses more on the possibility that large heparin manufacturers, Pfizer and Fastar, could eventually develop their own antimicrobial catheter lock products. Right, fair enough. But this implies for the mode in the near term regulatory position. Right, over the medium term. Okay. And how does... Okay. Now give me a detailed analysis of management's capability. Management of relevant renal commercial experience and is already used in the current window to lock in multi-year dialysis contracts, but the mode depends more on execution with large chains than on FDA alone. European Tourline payers can in principle enter the US, but it would need their own full FDA programs, which is a meaningful but not insurmountable barrier. Management's background and fit for this situation. CEO Joseph Tordisco has over a decade of experience in pharma commercial roles, including business development and deal making. He previously held senior positions in specialty pharma and is described as leading CorMedix through the transition to a commercial organization. CorMedix built a commercial bench specifically for DefenCath. They hired seasoned commercial leaders, such as Chief Commercial Officer with decades at Amgen, including the global launch of Sensipar and ESRD, patients on dialysis, plus senior commercial operations staff. Okay, so that's good that they're hiring this type of people. And this product is reasonably well aligned with the current challenge, selling a specialty product into a concentrated, highly negotiated US dialysis market, where relationships, contracting, and reimbursement navigation matters as much as classic drug promotion. Evidence they can capitalize on regulatory edge. CorMedix has already executed a 5-year commercial supply agreement with ARC Dialysis, a regional provider for system-wide adoption. They then sign a multi-year contract with a top-tier mid-sized US dialysis provider with commercialization of DefenCath in outpatient clinics. And CEO commentary explicitly framing this as part of a strategy to secure broad access via long-term relationships. Subsequent disclosures mention additional multi-year supply deals, including a later agreement with Premier Healthcare services provider that would provide access to thousands of patients, which indicates they are systematically using their first-mover advantage to embed DefenCath in protocols before any future entrants appear. On balance, this is what you want to see, a management team with prior renal specialty commercial experience that is actually converting regulatory time into locked-in contracts, rather than waiting for organic uptake. Nice. Ability to secure long-term deals before competitors. Factors in their favor. First and only on-label antimicrobial lock, right? Strong infection reduction and health economics data. Give them a compelling clinical and economic story for chains and payers. The dialysis provider universe is concentrated. Once you sign multi-year system-wide contracts and embed a product in clinical protocols and IT systems, switching costs and inertia work in your favor. Their explicit strategy, per press releases, is to pursue multi-year commercial supply contracts and broadest access possible via long-term relationships, which is exactly how you monetize a regulatory lead in a B2B protocol-driven market. Key execution risks. They still need to fully penetrate the largest LDOs. Any missteps in pricing, supply reliability, or contracting could slow adoption, leaving room for a late arrival to negotiate better terms. As volume grows, larger organizations will push hard on price. Management's ability to balance margin versus share will determine how much economic value they ultimately capture from the exclusivity window. Threat from European Toroladine players. European products like Torolock, Toroladine citrate heparin catheter locks already exist and are standard of care in some EU settings. However, these devices are not FDA approved for the US hemodialysis CRBSI reduction indication. Any EU company wanting to sell a similar product as a drug lock solution in the US will need to run a full FDA program, IND, pivotal trial, NDA, or partner license with a US entity. That implies years of development plus cost, and they would still face CorMedix's established clinical data, formulary positions, and multi-year contracts. So while European players are a credible medium to long-term risk, they do not appear poised to erode the moat immediately. Is FDA approval alone enough of a barrier? The FDA approval and associated exclusivities, plus the fact that no rival NDA is visible, give CorMedix a real head start. But this is not a high-margin oncology biologic with ironclad IP. Over time, regulatory barriers can be overcome by motivated competitors. The durable advantage will come from entrenched contracts with major dialysis providers, real-world data-proven value, and any additional indicators or portfolio expansion built during this window. Makes sense? From an investor's perspective, you mainly need to judge whether this team can keep executing. Yeah, exactly. That makes sense. Yeah, okay. All right, so now let me figure out that other thing that they... What is it that they say? TDAPA is a temporary extra payment that lets dialysis clinics be fully reimbursed for using DefenCath on top of the bundle ESRD rate. The later add-on adjustment is smaller, average bump once the generous period ends. So the transition is a headwind, but not a cliff, if CorMedix prices and contracts intelligently. What TDAPA is? CMS pays dialysis clinics. CMS? What is CMS? Big US government health insurer for old and disabled people and ESDs long-term kidney failure and requires regular dialysis to stay alive. Centers for Medicare and Medicaid Services. ESRD, end-stage renal disease. Meaning permanent kidney failure. Dialysis clinic. A center where ESRD patients often 3 times per week to have their blood filtered because their kidneys no longer work. For these patients in the US, Medicare through CMS is usually the main payer, even if they are not 65. How CMS pays dialysis clinics. Doesn't pay for each little item separately. Instead, it pays fixed bundle amount per dialysis session that is supposed to cover the treatment. What's the APA in plain language? Transitional drug add-on payment adjustment. Think of TDAPA as a temporary extra reimbursement CMS gives for new important drugs, so clinics are not punished financially. Oh, okay. During TDAPA, CMS says, on top of the usual bundle payment, we'll pay you roughly the full price of this new drug when you use it. But Defincat specially granted TBA starting July 1st, 2024. That means, okay. And it's from mid-2024 to mid-2026. Outpatient dialysis clinics can use Defincat and get extra money. Okay. I see. It removes the financial expense not to try the product. Once TDAPA ends, CMS doesn't keep paying the Defincat as a separate line forever. Instead, CMS increases the base bundle a bit for everyone by adding a small add-on adjustment amount per treatment, reflecting average spending on new drugs like Defincat. This is like saying we're now baking some of these new drugs' cost into the regular payment, spread across all treatments, not paying it dose by dose anymore. Right, very generous, covers most of the drug cost. Okay, until June of 26. Right, this is what we have right now, which again, it's been reflecting in their revenues, correct? Right, from whatever that started, July of 24, which is probably about this September we end here. Yeah, August, September, yeah, exactly. All this up until basically now. Well, no, up until the end of quarter 2, what we were reading earlier of 26. Right, so then after that, add-on roughly July 26 to June 29. Right, we still get the add-on though until 2029. Smaller extra amount per treatment built into the bundle. After that, Defincat is just part of the normal dialysis payment, no special extra. What this means for CRMD and Defincat. Right now, clinics can adopt Defincat with minimal financial downside, which helps CRMD convince them to switch protocols and sign multi-year contracts. Later, clinics will feel more cost pressure, so CRMD may need to offer better prices or volume discounts. Growth will depend more on how convinced clinics are about the infection prevention benefits. Well, the data behind Defincat are unusually strong for supporting dialysis drug. A big phase 3 trial plus real-world evidence both shows roughly 70% fewer bloodstream infections versus standard heparin, with clear statistical significance and compelling cost savings. Design randomized, double-blind, active control phase 3 trials in 795 to 806 hemodialysis patients using central venous catheters. Defincat versus heparin as the catheter lock after each dialysis session. Primary result, only 9 of 397 Defincat patients, 2% had a catheter-related bloodstream infection versus 32 out of 398, 8%. Infection rate versus 0.46. It is significant. Safety and catheter function. No meaningful difference in catheter removal, clotting, or patency between Defincat and heparin, so the infection benefit doesn't come with obvious usability trade-offs. Maybe the catheter removal, clotting, or patency between. Oh, okay. Doesn't come with obvious usability trade-offs. Okay. This is a kind of big, clean win trial data that gives clinicians and payers confidence the effect is real, not marginal. Real-world evidence, post-approval use, large ongoing study in a prospective real-world program involving more than 7,000 patients. Interim analysis through September 25 showed a 72%, again. That's pretty similar to the trial. Same analysis found 70% reduction in hospitalizations with this infection in a population where each hospitalization costs. All right. That's the good thing too, right? I didn't think of that. That obviously clinics would rather have no infections because that would require a higher cost eventually. Scale of the problem. CMS is estimated to spend more than $3 billion per year on these infection-related costs. So clinicians and administrators know this is not a niche issue. Real-world data that closely match the trial effect size strengthens the case. Cost-effectiveness model. For every 1,000 patients using Defincat instead of heparin was modeled to prevent 139 bloodstream infections, 117 hospitalizations, 16 ICU stays, and 11 deaths. Net cost, total costs were $1,535 lower per patient. Quality adjusted life years, better health for longer compared with heparin. Dominant. Nice. How convincing is this for clinics once CMS extras shrink? Likely to keep paying for a magnitude of effect. Dropping infections by 70% is huge in a setting where these infections are common, dangerous, and very expensive. It's not a subtle 10 to 15% tweak that can be hand-waved away. External validation results are published in a major nephrology journal and echoed by FDA's own summary, plus health plan monographs and economic analysis. Operational fit. The drug slot in, is easy. It simply replaces heparin in the existing catheter. Right, that's true too. Like, it's not too much of a friction to switch. What could still limit adoption? Local budget focus. Individual clinic operators may focus on their own drug budget. Right, the whole their own cocktail thing. Oh, and not realizing the risk or the cost of the risk of, an infection. Yeah, exactly. They just won't see the discount that TDAPA provides, and they won't have, I guess, the foresight to understand the cost that will come from more infections. Plus, again, it's all up in the air at that point. Variation in infection baseline. Centers that already have very low infection rates. Right, exactly. If they're already doing a pretty good job at avoiding it. Right, so that's, I guess, what I was going to ask next. The randomized trial shows a large statistically solid infection. Okay. Yes, there is a real ongoing infection-prone catheter use in dialysis patients, and the gap between current real-world infection rates and what Leffengat can achieve is large enough that the addressable problem is meaningful. How common are catheters in dialysis? More than 25% of established in-center hemodialysis patients were still using a catheter for access in 2024. Fistula use fell below 60%. Quality metrics specifically track percentage of HD patient months using a catheter for 3+ months, which tells you regulators use long-term catheter use as a widespread per system. So you can think roughly about 1/4 of stable dialysis patients are on catheters. What infection rates look like with current practice? A multi-center review found 7.74 catheter-related blast infection per 1,000. Which the author describes an unacceptably high incidence for long-term hemodialysis catheters. Other series report CRBSI rates between 3.8 and 6.6 per 1,000 catheter days. Right, and these people were showing 0.4, something like that they were saying earlier. In some settings, special resource limited and high-risk populations, 10 to 14 per 1,000 days. On the good end, all right, and again, once one of these patients get infected and many of them become hospitalized, which is a much higher cost. On the good end, one assessment of well-run US patient, right, 0. Much lower, right, a well-run, fair enough. Right, but if you have this thing that just reduces that significantly, right, look at that, 0.46, so it's even better on a well-established clinic, because it's 0.46. Wow. Oh, wait, the Lockheed phase trial, standard heparin log. Oh, the standard heparin log, 0.46. This we did to 0.413, right? So again, this will be more comparable, the clinical trial, to a really well managed, right? So now this is reduced to 0.13, right? So even though in this one's, right, with a not very well managed, that would mean that we go down from, let's say, yes, 70%, right? So 10 to 14, we bring it down. What is that, 3 to 3 or 4? Significant. Now, randomized trial with third line based showed 0.67 versus 2.7. Yeah, 70%. So against both heparin and citrate-terliidine-based logs are not shaving off a small sliver of risk. They are cutting infection rates by a factor of 3 to 4 in control settings. All right, it looks very good. Yeah, it's an addressable problem. They're the only approved solution. They have a head start. They have good management looking for opportunities and good contracts. So now the other thing we wanted to figure out. All right. They bought Melinta to turn CorMedix from a single asset dialysis company into a broader hospital-focused anti-infectives business. Added media revenue EBITDA and leverage the same customer footprint and sales info. Okay, that's right. So if they're selling the type of product, this other company, Melinta, that the same customer would buy, it makes sense because that way they can bundle into a whole solution and be like, hey guys, how about we not only sell you DefenCath, we sell you a whole bundle of anti-infection products. Strategic goal. Management explicitly frames it as transformational. Well, of course, they always frame it as transformational, creating a diversified, specialty pharma focused on acute and life-threatening infections rather than on a one-drug story around DefenCath. Financial rationale. Melinta brought about $120 million of 2024 revenues, expected to contribute 125 to 135. So if they were guiding for what, 400 million? So about, well, it's about half. About a third would come, so the other 2/3 would come from DefenCath, right? On a standalone basis, immediately lifting, right? That's on a standalone basis, not when it's bundled. Recent dependence. All right, platform rationale. Melinta has an established hospital acute care commercial platform, sales team, payer access. Right, there's also that, right? If they're targeting the same customer, and these people are acquiring a team that already markets to that customer, has those relationships. All they're doing now is at the same time adding this DefenCath product to the pipeline for these experienced workers and pipeline, and adding those other products to the DefenCath bundle. That companies can plug DefenCath, right, there you go, into, instead of building everything from scratch. Right, so they're at the same time buying adjacent products and the pipeline to commercialize both. They paid $300 million up front, $260 million cash, there we go. That's why we were like, how do they, what is the other part, right? It came from the million in equity, the 40 million in equity. 260 goes in line with the 140 that they had from their cash, plus another 140 or something from debt, up to $25 million of milestones and royalties, right? Which it goes right to the 300 and something with goodwill and acquisition of a business, which is sizable but aims to buy scale and diversification in one move. Again, yeah, that makes sense. Products they acquire. The acquisition adds 7 marketed drugs plus 1 cardiovascular product, Rezayo, Rizafungin. Once weekly IV echinocandin antifungal for invasive candidiasis, candidemia, oh my god, all these words, is in hospitalized or recently discharged adults with a planned prophylaxis indication in allogenic BMT patients. Minosin for injection, broad spectrum IV antibiotic. So yeah, there are a bunch of products for avoiding infections of different kinds, but as it seems, most of them, if not all, related to IV, which again is the same customer that will go with the DefenCath. Vabomere, carbapenem beta-lactamase inhibitor combo for serious gram-negative infections. And going, okay, so specific, yeah, they're for the more specific, I guess here. Again, as you guys know, I don't know much about this, but it all kind of makes sense in a general sense. Kimirsa, an orvoactive, long-acting IV for acute bacterial skin soft tissue infections, enabling single dose, again IV, and again Baxdilla IV for acute bacterial skin and some respiratory infections. Tropol XL, well-known extended release beta blocker for cardiovascular indications, adding a more mature but stable brand outside anti-infectives. Okay, so this one will be a little bit away from the anti-infectives. Collectively, Melinta's portfolio in hospital and clinic-centric, usually prescribed by infectious disease, physicians and hospitalists, and already generated around $120 million of revenue pre-deal. Why this product line specifically? Same call point. These drugs are used in inpatient and hospital adjacent settings, sold to pharmacy and therapeutic committees, ID physicians, and hospital purchasing. Not that different from how DefenCath is sold into hospital systems and dialysis organizations. Anti-infective synergy. DefenCath is an infection prevention product. Melinta adds treatments for several infections. So they're more like treatment. Okay. That positions CRMD as an infection solutions partner rather than a one-trick catheter lock vendor. commercial platform leverage. Melinta brings a built-out, hospital sales force. Exactly. That's what I think is most interesting, because the adjacent products, again, they're for infections. Now they will be like kind of good add-ons, but the main product is already the strength, right? DefenCath, it's strong, it has good clinical data, it reduces infections. That's what they're selling. Now they're selling you with the other stuff, but the main thing that is good about this acquisition is the fact, it seems to me, the fact that they have this pipeline for selling DefenCath that is much more mature. Risk balance, because this company was until very recently, a year, 2 years ago, basically focused on research. While DefenCath faces high payer concentration on time and risk, Melinta's portfolio is diversified across multiple indications and payers, smoothing revenue volatility. In short, they bought not just molecules, but an installed commercial engine and a portfolio that speaks to the same hospital buyers. How it complements DefenCath's go-to-market, ways to acquisition can help DefenCath shared customers, right? Hospital accounts, also between dialysis patients, interacts with nephrology and vascular access teams. CRMD more doors into systems where DefenCath can be placed on protocol. Cross-selling and contract, and they still have the advantage until mid-2026, 4 or 5 more months of just very well discounted because it's a new drug, and then they still have the add-on for 2 more years. So, it's kind of like, oh, you guys are already selling this anti-infection thing. How about preventing those infections better with this proven data? And at the same time, because it's a newer thing, a new development, the FDA or whatever, the CMS, is providing you a great discount until 2026. And that, it's like a great discount for starting, and then you lock them for later contracts. We still have the add-on until 2028, and you can re-sign later. It's a good value proposition, I would say, from the standpoint of a hospital provider. But what do I know? I don't have a hospital. Cross-selling and contracting with a broader anti-infective. I forget to look at the camera. I always look at myself in the screen. I should look at the camera. I'm sorry. Cross-selling and contracting with broader anti-infective basket. CRMD has more to offer in negotiations, potentially trading discounts or access across the portfolio. Right. Because again, they're at a point in which what they want is to get their DefenCath product into the pipeline, into the protocol, as they say, right? Before other players move in, because that way the friction to change will be high enough, and the other ones kind of have to prove that they're better than them on a clinical trial. So if they have good, strong data backing them, plus good, strong data in the real world, these other companies not only have to make a good enough product, get it approved in the FDA, but even if it's as good, it needs to be much better, right, to justify another switch. Scale and credibility. A multi-product hospital company with $300 million in pro forma revenue appears more credible and stable right, fair enough. A single product firm. The deal can reinforce DefenCath's go-to-market by enlarging the sales footprint, improving bargaining power, and making CRMD a partner of choice. Impact on financial prospects. What the numbers look like. Pre-deal, CRMD guided DefenCath 2025 revenue to about 180 to 200 million. Post-deal combined 2025, 300 million. Again, they already reported on that though, right? Didn't they? Right, we go back to, didn't you show me Q4 a second ago? Yeah, how do you get this? Yeah, what the hell? So I'm not tripping. That's why I was like, at first they showed me 23. Oh, sorry, Q3. And then they showed me Q4 again. Why are you playing with my feelings, bro? Yeah, so they already reported 25, that 300 million. Yeah, all right. Now it's the next quarter. When are they reporting the next quarter? $50 days. Around May 5th. Great. Yeah, we'll read this in a second now. How did they do in the quarter? Expected to contribute 125 to 135. I think we might have read it already, but let's read it again anyway. Or go over it. Preliminary results shows quarterly net revenue of $100+ million range, with the Melinta portfolio adding $13 million in just 1 month. Key financial implications: diversification, margin and scale. A broad portfolio helps absorb fixed commercial and G&A costs. All right, capital allocation risk, 300 million. Net, strategically, the acquisition makes sense as a way to de-risk deaf and cath concentration and deepen hospital relationships that can help deaf and cath and step up revenue and earnings power. Whether the price paid is justified by durable cash flows. Yeah, we gotta see how they're doing, but it seems like they're operating well since the acquisition. CRMD reported a net revenue of 128, which is beat by a lot, like 20%. 91 million. Deaf and Cath, newly acquired Melinta, 37 million. Full year 25. Why you say 400? That's the part that I'm like. Okay, I guess I'm starting to see why they will have high margins, because what they produce is not like a crazy biotech machine. It's like a lock-in device. So I guess it's not too hard. What do they produce? I guess that would be good to figure out. Long-term debt of 150 million. Yeah, they're already. Wait, yeah, this is negative. That's good. Total cash from finance. Yeah, they're reducing the debt already. They paid off 6 million. Yeah, look at that. So they're already retiring debt in a quarter. Good. I'll check the interest in a second, man. Okay. Interest expense. There we go. Right. Why up? Maybe the debt wasn't acquired, like, yeah, for the full quarter. Interest income, interest expense. Right, okay. Right. Okay. Income before tax 56. Right. This again is just like, I feel like this part here is not that relevant. The fact that this is moving up here. This seems like an accounting thing. Cost of revenue, 21. Right, that's from the acquisition. So right, so the lower margins on gross margins seems to come from the acquisition, because that would mean, what is the margin now? What is it? 129 minus 21 divided by 129. Yeah, 84 when they had 93 because of the new product line. Doesn't bother me too much. Interest expense. Right, the part is why if the principal went down. But again, I think it's because this debt wasn't acquired right at the beginning. Yeah. Where were we with this? Right. Pro forma revenue. Well, the 2025, if we had on Melinda from January 1st, right? For the quarter 4 25 press release, 311, right? Includes 258.8 from Def and Cath, the majority by 52.9 from Melinta, only from August 2025. Pro forma, right? They integrated it pretty quickly. Defined as full year Def and Cath plus full year Melinta revenues if Melinta had been part of CorMedix all of 25. Right, which is just doubling the millions. And then adding a little bit to, I guess, to the synergy to Def and Cath. Because if we just do 311 plus another 50, we wouldn't get to 400. So the roughly 90 million difference is basically Melinta's January to July sales, which are not CorMedix. Okay. Why the income statement and call summary disagree? Yeah, okay. You're just not being redundant. All right. I wanted. What did I want to ask? Well, let's check this here. Committees reporting revenue with Def and Cath contributing. Blah blah blah. The company affirmed 2026 financial guidance. Well, this is where I'm like, why is the guidance so low? It's because of the TAPA. What if that includes Melinta's pre-acquisition months? Yeah, sure. Pricing hit. Right. There you can add on kicks in. The baking reimbursement headwinds into guidance. Reported 2025 revenue, roughly 259 million. Right, so now what we gotta figure out is what did they guide for 2025? Because if they're conservative, pro forma 25 of 101, right? But no, it's not real. Yeah, I get that. Total, we definitely got between 150 to 170. Even though here, we already got a good. What did they say it was? Uh, 258. So what the hell? Right, again, because of the right. Yeah, the discount thing going away. 2026 definitely revenue will be front loaded with price erosion. Commentary on third party notes tie the lower than expected 2026 guidance direct to this TDAPA. In other words, they are saying out loud the definite peaks are around 260 million in 2025 and the steps down on the reimbursement pressures. All right. So related to the story you just laid out, management is essentially assuming the price compression on definite more than offsets volume. Definite still under full TAPA for all 12 months. Good old TDAPA. The step down happens. Price resets and tougher negotiations, such that definite average net price for the year is much lower. Volume growth. How customers is actually trending. They moved from initial inpatient launch to outpatient TDAPA and signed multi-year deals with regional provider. At least one top-tier mid-sized dialysis chain. Updates mention expanding within these systems and adding additional large accounts. A real-world study of U.S. renal care. It was 7,000 patients. Substantial penetration, at least in that network. Management talks about continued strong new site activations on rising catheter patient coverage. So yes, the customer base and treated patient base are still growing rapidly. Additionally, right, unit volume is going up meaningfully. Why price still dominates the math? The problem is the size of the pricing step down. Under TDAPA, CMS essentially pays clinics close to the full. Alright. From 1st July 2026, payment switched to a fixed add-on amount, which is much smaller. Right, okay, so it is much smaller. Alright. Clinics that use DefenCath on a large share of catheter patients will see an immediate squeeze on per dose margins. Right. And they basically say they want to protect volume and long-term relationships. Right. To do that, they will be repriced for big users around the time TDAPA ends, which means lower net revenue. Right. Right. That makes sense. Yeah. Reduced price by, damn, I just didn't know it was such a reduction. Right. Price down 45%, volume up 30%. Those aren't exact numbers, but the key idea is price falls faster than volume rises. How Melinta are in a more mature go-to-market hub, but not enough. Bigger sales footprint, contract leverage, credibility. Management does build some of it into guidance. When it's expected to grow modestly, expect to keep rising, but they're not collapsing adoption. Right. They're choosing to let price flex down materially to maintain and grow share. Makes sense. That's good. If DefenCat's infection reduction and cost savings data convince clinics more strongly than management assumes, volume could ramp faster, more patients per clinic, more systems converted, and the price cuts needed to keep adoption high might be less severe. In that case, DefenCat could do 170 million, which is still significantly lower than this year. But again, it's a 30 to 40% price drop. Which it might be even more if you think about it, because these customers will have to pay it. Base case, realistic caution, dialysis. Dialysis is a brutally cost pressure protocol driven business. When a generous carve out ends, large chains push hard on unit price and some clinics will underuse even value-adding drugs if they feel underpaid. Management has probably had frank conversations with big customers already, which is why they're willing to publish a guide that disappointed the market. They see very real pricing. Okay. Management's plan in 2025 was to guide cautiously at first and raise guidance multiple times. Nice, that's good. So the start so far has been closer to start conservative and walk it up than to over-promising. What they guided for 2025 and when? End of 24, early 25, after announcing Melinta, initial 25 pro forma revenue guidance, 325 to 350, and they walked up to 400. Nice. Strong momentum past an early view. After preliminary results showing 100 million to 125 million pro forma revenue for the quarter, driven by stronger than expected deaf and cat use at the large dialysis organization and the customer, they raised full year. With full quarter 3 release, they raised it again to a range of 300 million to 410. Also increased 2025 pro forma adjusted EBITDA guidance for 2020 to 240. Wait, what? 100 million reported revenue. Right, after preliminary. Okay, end of 24, right, is when they did that, right? Now, quarter 3 of 25 is when they do the update, right? Getting close to the end of the year. Right, so this is where we'll see something similar to in 26, I assume, in which they'll continue to be conservative even if they're performing well. And then once they get data on how they're performing after the TTAPA expires, quarter 3 of 26, the first quarter in which they're moving on to the add-on, then they'll raise it. Which I think is, I mean, that's what I would see. Now, does that now, it all starts to add up as to why the price would be depressed, which is, even with all of this, people are like, they're like that, you know, they're like, I don't want to hold it. I don't want to hold it through this. Can you take me back to where I was, brother? All right. Yeah, so, wait, but again, now this is the thing. I guess they were already looking forward to that, like the moment they announced the APA or something. Like, is that why the stock halved? Again, yeah, margin of safety is so good. Yeah, it's just the volatility, whatever. The volatility, this is all technical stuff that will fade out. The fundamental is great. Damn. Wait, oh no, okay. Well, that's still high, isn't it? Percentage 21%? I don't get it. Why? Why is there so much? That's the next part of the study, I suppose. Why is the market not liking it? All I see is good stuff. I mean, not like, you know, I get it, like it's a transition year, blah, 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 but... Okay, what was I gonna look up here? I came here, yeah, to see the price, alright. Yeah, like that's why it makes sense, I suppose. Right, so then after preliminary quarter 325 results showing 100 million reported revenue, 125 pro forma revenue for the quarter, they raised full year to 375. With a full quarter 3 release, they raised it again to 390 to 410. And also increased 2025 pro forma adjusted EBITDA. So the trajectory was 325, 375, 390. How actual 2025 performance compared? Reported 25, 311. Pro forma, right? So yeah. Yeah. So they started 25 with guidance that proved too low, then raised it twice as the year unfolded. Final guidance was reasonably accurate, and they ended up delivering close to the high end of that range. Well, I don't know if that's close to the high end. They're just in the middle. Consistent with the management team that avoids aggressive initial guidance. Nice. Current 2026 revenue guided 300 to 320. Should be read as their current honest base case, not as a stretch number. That's great. Nice. All right. Okay. So it all looks pretty good and reasonable. Then 2026 is a transition year, and management is guiding conservatively, even with their, I actually don't know that. I was gonna say even with their guidance. Bundle add-on with expected price erosion, come anticipate meaningful increase in provider reimbursement. That should translate to higher net selling price compared to late 2026. Spec study. Company and the questions. Alright, but guidance of 300, 320. You're not missing anything obvious. The setup is fundamentally attractive, but the market is heavily discounting costs because it is treating DefenCat as a peaking, reimbursement-dependent niche asset, with visible near-term revenue and pricing headwinds, plus usual small-cap biotech risks and big, recently levered bet on Melinta. Why the market is skeptical? The main reasons that that show up repeatedly in commentary: hard reset on DefenCat economics. Analysts and articles explicitly frame July 2026 as a cliff event where TDAPA ends, net price drops sharply, and DefenCat revenue falls from 259 to 150. Peak product narrative. Some pieces now talk about peak DefenCat and tough road ahead, implying the street sees DefenCat as at or near peak with declining revenues. I don't get it though. Even if 2026 doesn't grow, it will continue to grow later. Guide shocks versus expectations. The initial 2026 guide was meaningfully below prior informal expectations, which triggered a one-day stock drop. But that's not even right. Didn't they? Or maybe they gave the guidance then? So even though you see 300 to 320 as solid, the market has been pricing in continued growth. Short interest and what shorts are betting on. Short interest around 25 to 26% of floor is indeed very high, and as recent into and through 2026 guidance cut. From short side and skeptical write-ups, the main thesis is that reimbursement overhung. TDAPA add-on transition is seen as a structural cap on DefenCat's economics. Shorts argue that once a CMS subsidy fades, dialysis chains will push prices down hard and may underuse DefenCat despite its clinical benefits. 1.5 product risk. DefenCat is still the only big proprietary asset. Melinta's portfolio is viewed as a collection of older, competitive anti-infect. Yeah, I get that. That part, I agree. Execution and trial risk. Shorts point to upcoming pivotal trials. In this fail or delay, the long-term growth story and diversification thesis weaken materially. Valuation reset. Some analysis argue that even at a lower share price, the stock still embeds optimistic assumptions. When you rebound on pipeline success, they see more downside if these don't materialize. Key perceived uncertainties, magnitude and duration of price compression will be materially lower, versus where clinics will demand deeper discounts than modeled, or that the add-on level may not fully compensate heavy users, pushing both price and volume down. Volume versus price. In reality, you're assuming volume. New clinics will outweigh price declines. The street has seen many dialysis ESRD drugs where price pressure crushed revenue despite strong data. Until there are a couple of post-TDAPA quarters proving the opposite, the market leans cautious. Melinta acquisition risk. Then a big check. If Melinta's brand underperform, face generic competitive pressure, or require more selling general administrative to maintain than expected, the diversification can end up diluting rather than enhancing value. Small cap biotech hair. Investors factor in typical risks, key person risk, regulatory surprises, any future equity raises in cash burn picks up new trials and discount the equity more aggressively than for mature large cap. So the discount is largely about uncertainty and asymmetry. It's easy to imagine scenarios where DefenCat's economics disappoint post-TDAPA, whereas the bullish outcome requires several things to go right. Why your view can still be different and rational. Your lens emphasis, right, yeah, exactly, the data, right, but it's, okay, so we need two things to look into now. Companies like this, the market is pricing the worst case interpretation of the reimbursement. You're betting those risks are manageable and that 2026 trial is temporary. Right. And give me a break. I don't want KPIs. Let me see here. This is what I want. No. Yeah, this. No. Where are we? Like the one is. Yeah, here. The closest real world analog the series is thinking about is calcimimetic class sensible perceptive, going from separate payment to the AP into the ESRD bundle, where use and economics clearly got squeezed once the special payment ended, even though the drugs had strong clinical data. What actually happened with calcimimetics, the main precedent? The key ESRD examples are the calcimimetic cinacalcet, sensipar, okay, and this is IV, okay, used to treat secondary hyperparathyroidism, thyroidism, I think, thyroidism in dialysis patients. Under TDAPA, CMS paid separately for calcium outside the bundle, which made it financially easy for clinics to prescribe. After TDAPA started, CMS incorporated calcimimetics. What happened to use? Policy analysts this predicted a drop in calcimimetic use after bundling during a parallel to ESA, which fell markedly as in 2011. CMS and Amgen materials show that after calcimimetics were added to the bundle, they receive a fixed stream for the entire class, regardless of whether they actually use Parsabiv or an alternative. Academic commentary notes that once the TDAPA expires, calcimimetics will be bundled. Right. So TDAPA drove an uptake bump, bundling shifted incentives, and use was expected, and in practice observed, to soften because facilities now bore more. How similar is the situation to DefenCat? Same payment framework. Right. Same economic dynamic. Yeah, I get that. Fixed add-on base. I just want to know that the strength of the drug. Strong incentives to economize once separate payments ended. You must have a nice to have, because it makes improved biochemical markers. Yeah, exactly. It doesn't seem as much. Mere consequences of reducing doses can feel less dramatic. Acute catheter bloodstream infections, events that quickly cause sepsis. Yeah, this seems much more. Calcimimetic benefit is real, but more distributed over time and influenced by other management choices. Different has a large crisp effect. Who pays when you underuse? For calcimimetics, much of the harm is underuse. Fractures, vascular calcification, mortality is longer term and may not directly hit the dialysis facility's budget. For catheter infections, many costs hit the dialysis chain and its parent more visibly. So while the payment structure is analogous, the clinical and economic visibility of the Fincan's benefits is arguably stronger and more immediate. Volume behavior under TDAPA. A recent Medicare study showed TDAPA for calcimimetics increased the proportion of dialysis patients receiving calcimimetics by about 9.8 percentage points. In some coverage groups, clear uptake but not explosive. Still, average Parsabiv utilization during TDAPA was only 6% of dialysis sessions. So there's room for more use, while also showing clinics didn't put everyone on it, even when a payment was generous. Has not disclosed a single clean percent of catheter patients. But milestones show rapid scaling from initial inpatient launch to major outpatient contracts. Quarterly DefenCath revenue going from essentially zero to more than 60 million per quarter by late 2025, indicating very strong uptake relative to a niche catheter population. We don't have a peer-reviewed before versus after yet, but the revenue and real-world study scale suggests a faster and broader ramp in its eligible population than what calcimimetics saw in theirs. Management, yeah, I mean, this all, yeah. I mean, I'm pretty convinced at this point. So what we're going to do for the rest of the show is just going to listen to management's last call. And yeah, I think that's good enough. Calcimimetic era. ESA and calcimimetic reimbursement changes were being navigated by very large operators in a policy environment that was still learning how to integrate drugs into the bundle. A key lesson: once payment picks up the full cost of a class inside the bundle, studios may cut doses or tighten criteria aggressively, and policymakers then worry about undertreatment. DefenCath CRMDs. CRMDs or CRMDs. Management includes leaders with prior dialysis sector experience, previous work at Amgen or Sensipar, and ESRD products, which gives them direct lift experience in exactly the calcimimetic ESA transition. They are explicitly communicating that they will proactively reprice and contract heading into July 2026 to protect volume and keep DefenCath in protocols, having seen what happens if you let bundling changes blindside you. So in this respect, they are arguably better positioned to handle the transition than prior guinea pigs of TDAPA bundling rules. Why the street still applies the calcimimetic template? From the street's perspective, the cautious parallels are: TDAPA ends, add-on-based rate is set off utilization data. Large chains now face a finite per treatment subsidy instead of a drug-by-drug reimbursement. Past experience, ESAs. I mean, I still see that the main thing is the fact that you say, oh, well, they don't get a discount. But if the cost saving is still strong enough to justify paying for the treatment, like, in other words, if it's not as much a comparison between this drug before and after the discount, but a matter of, if I don't use this drug, I pay more money, then the TDAPA is kind of a nice add-on. Whereas if not using DefenCath was similar to the calcimimetic, in that if I don't use it, fine, you know, like I have a high risk of whatever. What was it, like calcification of what was it that he said it here, like fractures, vascular calcification. So mortality longer term is like an effect on how. I mean, I'm not that familiar with the drug, but it's not an infection that would cause an immediate hospitalization, and the effects are strong enough that means if now until also later on, which they'll be using the product, they see that they have less hospitalizations, that is an actual cost saving effect. So not using it, even though now it'll mean a higher cost, that higher cost is lower than the cost of not using it. So that's where I think is the main huge difference here. But let's keep seeing here. Where were we? Yeah. Until you see several quarters of past TDAPA, proving the volume. But it is fair. Your thesis is essentially that DefenCath's clinical economic profile plus management's experience mean it will break that historical pattern. Yeah, I think so. I mean, it's a different case. Bottom line comparison in your terms, did those prior drugs have strong data? Has a cleaner, more dramatic data and very visible outcome? Did volume trend up rapidly? No, it didn't for that. Think about it the right direction. For catheter infections, the avoided costs are big and very in your face, so it can absolutely be more expensive for a clinic ecosystem not to use DefenCath. Though whether the dialysis facility itself fully internalizes those savings is the key nuance. How DefenCath's cost saving works. Clinical effect. DefenCath cuts catheter-related bloodstream infections by about 70%. Economic effect. A 2025 model estimated that per 1,000 patients prevents 139 infections. Yeah, right. This is total cost. Right. But the question is, the clinic care. Yeah. Similar lowest PDAH and long-term complications of secondary. Their abundant facilities could reduce our tightened use without immediately triggering big obvious acute care. That's why it was easier behaviorally and financially. The nuance, who actually bears the cost, where your logic is clearly correct. At the overall healthcare system level, using DefenCath is slightly more expensive. Where it can get fuzzy, dialysis facilities are paid via the ESRD bundle. Many of the hospitalization and ICU costs for infections are borne by Medicare Part A and hospitals, not directed by the dialysis clinic's dialysis budget. If the clinic's own drug budget goes up with DefenCath while much of the savings show up in someone else's bucket, some operators may still underuse it unless reimbursement and contracts are structured to share those savings back. Mechanics to align the clinic's economics with the system level savings. Net answers to your question. Oh, that's why they like them to use it. So I'm sure you're right. Practically, what the clinics behave, though, it depends on what the payment and contact. You're asking the right question. Management CMS have started to move in the direction you're describing. The data say not using DefenCath is more expensive for the system, and there are early signs of policy tweaks meant to push more of those savings into the clinic's bucket. But it's not fully solved yet. What management has said about incentives. On CMS policy changes, CRMD publicly praised the 2024 CMS Innovation Center update to the Kidney Care Choices value-based care model that carves TDAPA payments out of the financial benchmarks and expenditure calculations used to judge participating nephrology groups. Why it matters. Before this change, if a KCC, Kidney Care Choices nephrology practice, use a TDAPA drug like DefenCath, those extra drug costs could make their total spend look higher. Right, because the TDAPA was a cost for the CMS. Those extra drug costs could make the total spend look higher on how their performance metrics. Carving TDAPA out removes that penalty and makes it easier for these providers to adopt DefenCath without being dinged in the shared savings math. CEO Todiscus framing. He explicitly said this KCC change will align provider incentives with patient care and broaden access to innovation and better allow providers to more easily protocolize a product like DefenCath across clinics and patient payer segments system-wide. Oh, wait, sorry, I didn't quite read that. The KCC change will align provider incentives with patient care and broaden access to innovation, better allow providers to more easily protocolize a product like DefenCath across clinics and patients' payer segments system-wide. That is basically management saying, we worked with CMS and stakeholders to make sure providers aren't punished for using our drug. This is one step toward aligning the economics with the clinical benefit. They've also emphasized TDAPA and then the post-TDAPA add-on as mechanisms that give clinics explicit extra payment during the early years, so adopting DefenCath doesn't blow up their dialysis budgets, while they're still proving the real-world value. Their own contracting strategy, multi-year agreements, volume-based discounts, cross-portfolio deals with post-Melinta, right, to make sure customers feel they are being made whole economically, not just told, trust us, the system saves money. What CMS has done so far to align incentives, two concrete examples, TDAPA and add-on strike, well, but that's, yeah, to avoid underuse of new dialysis drugs. For at least 2 years, clinics get paid roughly 100%. Right. Starting 2024, added post-TDAPA. Oh, so they added that very recently. An extra payment per treatment for several years after TDAPA, intended to keep some incremental support. KCC carve-out from January 2025, the Kidney Care Choices model. Oh, so it already even covers that, right? Excludes TDAPA payments from the spending benchmarks and performance calculations. That means nephrology practice in KCC can use DefenCath and get TDAPA payments without looking worse in a shared savings math. Sure, I mean, I don't see how that would really have an effect post-TDAPA. At least for that segment, right? Those most show CMS is aware of the issue. They are trying to avoid creating incentives for clinics to underuse clinically valuable cost-saving drugs. Does this fully solve your who saves and who pays concern? Not entirely, but it helps. Right, the clinics are essentially right. Yeah, that's no problem. Between TDAPA and KCC carve-out, there's little financial downside for using it, which is why this period is so important for protocolizing and embedding DefenCath. Post-TDAPA, clinics get a smaller fixed add-on per treatment regardless of actual DefenCath use. If they use DefenCath heavily, they may still feel some pressure unless the add-on is generous enough. It's a price to fit under that umbrella. CMS can adjust add-on calculations. Right. But those are slow macro levers. Oh, not tailored per drug beyond the initial formula. The agency's explicit language for TDAPA says its job is to help ESRD facilities incorporate new drugs, make appropriate changes for the business to adopt such products, but after TDAPA add-on years, CMS expects the bundle to handle it. So CMS is given a structural window where incentives are much better aligned. Beyond that, it's mostly on core medics and the ASS organizations to negotiate contracts that reflect the downstream savings. I just don't get why the downstream savings would ever be something that the clinic would care about, though. I guess because they lose the customer the moment they have to hospitalize it. Right, because the clinic would lose that patient. Plus, I suppose it's a bad, it's bad rep. Embed deaf and cath in care pathways. Build real-world health economics data to justify continued use even after the reimbursement training wheels come up. CMS has already shown willingness to tweak models. Just misaligned incentives. The thing is underused because of economics that become fodder for MedPack, VPS common cycles. So you mentioned that, yeah. Want to push clinic to buckets, they will use deaf and cat is conceptually right. We already see partial steps in that direction. The remaining risk is that the alignment is not perfect post TDAPA, and clinics still lean on core medics for price concessions. I mean, they will to some extent. How CMS sets and later tweaks the add-on number. Right, so the add-on amount of deaf and cat is already set for the first part. Okay. CMS will then recalculate it every year using fresh utilization and cost data. So if underuse becomes obvious, the adjustment can move, but only gradually and via the annual rulemaking cycle. Damn. When the add-on is determined, sets add-on amounts in the annual ESRD PPS rule for upcoming calendars. Proposed rule around June, final rule in November. All right, so we got June for them to propose that. For 2026, CMS had already finalized the post-TDAPA add-on for deaf and cat at $2,371.10 for dialysis treatment. CMS calculates these amounts using about 12 months of recent claims and ESP data. So the first deaf and cat add-on is known. How and when the add-on can change. For each quarter, right, wait. We calculate the post add-on every year for each quarter based on the most recent 12 months duration. A drug can be included in the add-on calculation for 3 years to TDAPA ends. So deaf and cat will have an add-on adjustment through about mid-2029. There is essentially total spend on the new drug divided by total ESRD PPS spend. Adjusted for case mix and multiplied by 65% risk sharing factor on a price index. If actual use is higher, more spend, the ratio goes up, and all else equal, the add-on can drift higher. If use falls, the add-on can shrink. Wait, right? So then, shouldn't it make sense that they put more add-on and the use shrinks? With underuse becomes a problem. There are two levers. Mechanical, within current policy. High utilization and ESP data feed into the formula and can actually raise the add-on over time. Improving economics for heavy use clinics in later years. Conversely, if clinics underuse deaf and cat, its share of ESRD PPS spend falls, and the add-on may not grow, or could even drift down, reinforcing the underuse pattern. Policy rulemaking, if CMS sees misalignment, can revise the methodology in future ESRD PPA rules, changes the 65% risk sharing. Right, so that's slower. So we just gotta see this growing, even at the lower. Yeah, I mean, just the add-on. For second half of 26, you can treat the 20 per treatment as fixed. Your thesis then hinges on whether core medic's net price and clinic contracts fit under the umbrella. Yeah, no, okay. All right, so yeah, we just have to listen to management. But yeah, I mean, the main worry that I have now with this is the fact that the clinic doesn't have to give a shit. Or I mean, or not even that. Is yeah, that the CMS, like we're kind of holding for the CMS to realize the cost saving and incentivize the clinics accordingly. Right? Because I don't see why the clinic would care. All right, I think that's enough in the sense like I'm going to go feed the dog, heat up my own food, and then we'll listen to the call. Be right back. I just realized, well, we're getting to the 3-hour mark anyway. So we'll listen to some of the call, or maybe just look at a little bit of the transcript where we listen to it, and then I'll be out of here. You know, I feel we made the case here for the stock anyway. We have pretty good analysis, and the rest will be just calm. But let's see anyway. So. Oh, there we go. Why, man? Why is my computer like this, bro? I don't know what's going on that I cannot. I don't know exactly why it does this thing in which I cannot. Some things I just cannot. I don't know what it is. Like I press some play or some stuff and in some places. But anyway, let's see here. If I go to CRMD, oh, they are. Jesus. Maybe here. Hopefully they let me do it. Yeah, I mean that's. What was it anyway? Oh, here. Not to report. Man, what the March 5th. Where is here? Tour, where does it say tour report?
EVP and Chief Commercial Officer,
Sorry about the
and Dr. Matt David, EVP and Chief Business Officer, are also on the line and will be available during the Q&A session. Before we begin, I would like to remind everyone that during the call, management may make what are known as forward-looking statements within the meaning set forth in the Private Securities Litigation Reform Act of 1995. These statements are statements, other than statements of historical fact, regarding management's expectations, beliefs, goals, and plans about the company's prospects and future financial position. Actual results may differ materially from the estimates and projections on which these statements are based due to a variety of important factors, including the risks and uncertainties described in greater detail in CorMedix filings with the SEC, which are available free of charge at the SEC's website or upon request from CorMedix. CorMedix may not actually achieve the goals or plans described in these forward-looking statements. Investors should not place undue reliance on these statements. CorMedix does not intend to update these forward-looking statements except Form 8-K sales. At this time, it is now my pleasure to turn the call over to Joe Tedisco, Chairman and Chief Executive Officer of CorMedix. Joe, please go ahead.
Thank you, Dan. Good morning, everyone, and thank you for joining us on this call. 2025 was truly a transformational year for CorMedix. While DefenCath achieved peak sales of just under $260 million, we are excited to have both announced and closed the acquisition of Melinta Therapeutics in the third quarter of the year. In addition, the team worked expeditiously to facilitate integration and achieve our target synergy of $35 million during the fourth quarter of 2025. This was a monumental achievement and truly a testament to the operational execution capabilities of the CorMedix leadership team. As we turn our attention to the year ahead, there is much focus on our post-TDAPA add-on period strategy for maintaining patient utilization rates for DefenCath in outpatient hemodialysis. As a reminder, on July 1st of this year, the TDAPA reimbursement for DefenCath will transition from a buy-and-bill format to a bundled add-on mechanism. We've had multiple conversations with our top customers and are in the process of finalizing supply pricing for Q3 and Q4 of 2026, as well as for 2027. At this time, we are affirming our 2026 DefenCath guidance of $150 to $170 million and 2027 DefenCath guidance of $100 to $125 million. With respect to 2026, we expect much of the revenue concentration to be front-loaded in the first half of the year as price erosion related to the post-TDAPA add-on occurs in the third and fourth quarter. Assuming CMS utilizes the same methodology to calculate the 2027 bundle edition, we do expect a meaningful increase in traditional Medicare provider reimbursement in 2027, which we expect to translate into a higher net selling price in 2027 compared to Q3 and Q4
Right, that's with the readjustment of the add-on that we were talking about.
To that extent, we took the extra step of issuing 2027 DefenCath guidance, which is based on existing patient utilization rates as well as our current estimates for the range of net selling prices, and does not include potential upside from new customers or managed care contracting. In addition to DefenCath guidance, the company is also affirming its full year 2026 financial guidance of revenue of $300 to $320 million and adjusted EBITDA of $100 to $125 million. That said, we are actively in discussions with multiple Medicare Advantage providers, as well as new potential customers for DefenCath in both the inpatient and outpatient settings of care, focused on execution of sales and marketing efforts for REZZAYO, Minocin, and Vabomere, and will evaluate appropriate updates to financial guidance as we progress throughout 2026. This past month, we completed our first Analyst R&D Day, in which we focused on educating our analysts and investor community on the market opportunity for our antifungal product REZZAYO in its current approved indication in the treatment of invasive fungal infections, as well as our key pipeline assets of REZZAYO in development for prophylaxis of invasive fungal infections and DefenCath in development for prevention of CLABSI in adult patients receiving total parenteral nutrition. Liz will provide an update on the status of these development programs shortly. During the Analyst Day event, stakeholders were given the opportunity to engage with multiple panels of physician thought leaders around key aspects for each of these three growth opportunities for CorMedix. The webcast of the event and associated materials remains available on our website, and I encourage all investors to review those materials. The feedback from thought leaders was excellent and underscores our view for the large potential market opportunity for REZZAYO, which we estimate at approximately $2.5 billion across both potential indications, and for DefenCath and TPN, which we estimate between $500 and $750 million. 2026 is expected to be a transitional year for CorMedix, with a heightened investor focus on new catalysts and value drivers, most notably our Phase 3 RESPECT data for REZZAYO and prophylaxis, which is on track for the second quarter of this year. With the acquisition of Melinta, not only did we acquire what we believe will be an exceptional growth asset in REZZAYO, but also added highly durable institutionally administered products like Minocin and Vabomere, which we expect to provide a stable base of revenue while the company builds toward future growth. I believe CorMedix has done an exceptional job of maximizing the value of the initial TDAPA period afforded to DefenCath in outpatient hemodialysis, and parlayed that success into building a pipeline that positions the company for long-term sustainable growth. I'd now like to turn the call over to our Chief Operating Officer, Liz Hurlburt, to provide an update on clinical activities. Liz, please go ahead.
Thank you, Joe, and good morning. The combined clinical development and operations teams, along with field medical affairs, have been working diligently on numerous clinical activities. As we shared last fall, enrollment for the global Phase 3 RESPECT study evaluating REZZAYO for the prophylaxis of fungal infections in adult allogeneic bone marrow transplant patients completed in September. This pivotal trial is being conducted by our global partner, Mundipharma, who has confirmed that all sites have completed study participation and they are on track for an anticipated database lock later this month. We expect to announce top-line data from the RESPECT study in the second quarter of 2026. Top-line results will include the primary efficacy outcome of fungal-free survival at day 90, discontinuation of study drug due to toxicity or intolerance, all-cause mortality and attributable mortality with invasive fungal disease as determined by the Data Review Committee, and the cumulative incidence of invasive fungal disease at day 90 by the Data Review Committee and by Azole Choice. Additionally, safety data, including overall adverse events, treatment-emergent adverse events, and serious adverse events, is expected to be included in top-line results. The team continues to work closely with investigators and clinical experts in the field to deepen our understanding of the evolving clinical practices and the needs of these patients as we prepare to support a potential commercialization in 2027. As Joe mentioned earlier, our panel of thought leaders provided excellent insights into the market opportunity for a long-acting echinocandin in the prophylaxis of invasive fungal infections, and we are looking forward to our Phase 3 data readout. Turning to DefenCath, I'm pleased to share that the Phase 3 NutriGuard clinical study, which is evaluating the impact on central line-associated bloodstream infections, or CLABSI, for adult patients receiving total parenteral nutrition via a central venous catheter, is approximately 30% enrolled toward our minimum patient target of 90 patients. and we are working to increase enrollment rates as we progress throughout 2026 with new sites in Turkey. At this time, we are still anticipating study completion in early 2027. The adaptive design of the NutriGuard study allows for a minimum of 90 and maximum of 200 participants based on the incidence rate of CLABSI. An interim assessment will be made by the Independent Data Monitoring Committee after 15 participants have experienced a CLABSI event. I would now like to turn the call over to Susan to discuss the company's fourth quarter and full year financial results and financial position. Susan?
Thanks, Liz, and good morning, everyone. We are pleased to share our fourth quarter and full year 2025 financial results, which reflect our ongoing commercial and operational execution. A few things to note on the financial results before I jump in. Following the close of the Melinta acquisition on August 29, 2025, the fourth quarter of 2025 represents the first full reporting period incorporating of $120.4 million, meaningful $3 million from 17 strategic focus serves to launch opportunities of defense established in the third quarter of the tax benefit and expenses $43 million from the fourth quarter of 2024. Turning to non-GAAP results, adjusted EBITDA for the fourth quarter was $77.2 million, which was within our previously established guidance and reflects modest growth quarter over quarter. This metric excludes one-time acquisition-related and reorganization costs, stock-based compensation, and the tax benefit and expenses recognized during the year, and it provides additional insight into the strengths of our core operating performance. A reconciliation to GAAP results is included in the press flexibility and commercial momentum.
2025 was a transformational year, and 2026 will be a transitional year that we believe sets up CorMedix for long-term sustainable growth in 2027 and beyond. We recently announced a share repurchase program and have been active in repurchasing shares throughout the first quarter. We intend to continue to be active throughout the year, subject to normal blackout periods, applicable volume restrictions, and other business needs, as we believe our balance sheet has sufficient flexibility to pursue this repurchase while leaving sufficient dry powder for new business development opportunities. The company sits here today with a diversified product portfolio, multiple late-stage pipeline opportunities, financial flexibility, and a capital structure to support future growth.
Right.
We remain confident in the outlook for this year and our path to future growth and sustained profitability.
Right. They about here. That makes sense.
I would like to now open up the call for Q&A.
I'm at the same
We will
point.
now begin the question and answer session. To ask a question, you may press star then one on your telephone keypad. If you are using a speakerphone, please pick up your handset before pressing the keys. If at any time your question has been addressed and you would like to withdraw your question, please press star then two. The first question today comes from Roanna Ruiz with Leerink. Please go ahead.
Hey, morning, everyone. A couple questions from me. I was thinking, in terms of your conversations with dialysis customers and talking about supplying contract pricing for DefenCath, could you give a little bit more color on how those are going? Are you trying to build in certain features to drive DefenCath volume in 2026 and beyond, or how are you thinking about these different levers?
Hey, thanks, Roanna. So I'd say conversations that I believe are going fairly well. The near-term focus is on preserving patient utilization through the back part of 26 and creating a structure for an increase in selling price in 27. And that's what we've been working toward negotiating with customers, and that's what we're hopeful we'll be finalizing shortly. We are also setting these up with flexibility to allow for changes in the event we are successful with Medicare Advantage contracting as we progress through this year and into next year. So overall, I'm happy with the progress that we've made and hopeful in the near term we'll have some things finalized for the back part of the year.
Sounds good. And then I had a different question about REZZAYO. It sounds like you're going to share a lot of interesting information with the top line for the phase 3. Could you help frame what in that information you think is most clinically meaningful for physicians? How do you plan to leverage some of this data in potential future discussions with payers, et cetera, if all goes well and the top line is positive?
All right, thanks. Before I let Liz comment, I'll just give you a little bit of my thoughts. And the way I look at the RESEO top line data, I think there's obviously various degrees of success, right? There's meeting the top line endpoint, and then there's going to be different aspects of the pathogen data within the top line data, as well as secondary endpoint around the discontinuation of the standard of care. And I think obviously what we're able to show will guide toward the commercial utility and how we're going to think about marketing and promoting the product. But Liz, do you want to comment any further?
Sure. Roanna, I think when it comes to how we're going to use the data, a lot of this is going to be dependent on the pathogens that we see in top line. Obviously, the more, the better. I think if we are successful in the way that RESPECT reads out, there is a lot of opportunity for us to be able to talk to the payers about an option that does not have the drug-drug interactions that the azoles and some of the other therapeutics are presenting right now. And we're hopeful that that will lead to understanding around less hospitalizations, getting patients out quickly and to more safely be on their anti-cancer regimens. So it'll be certainly data dependent, but I'm confident that once it comes out, we'll be able to take a look at that data and strategically place it with payers and the clinical community.
Understood. Thanks.
And the next question comes from Les Sulewski with Truist Securities. Please go ahead.
Hey, this is Jeevan on for Les. Thanks for taking our questions. First, any developments on the bipartisan proposed TDAPA extension bills, and if the timing here has changed based on recent global events? And then also any updates on a potential partnership with the other LDO and how post-TDAPA dynamics change the odds here? Thank you.
Thanks. Look, on legislation is always speculative. What I can say is that we've spent a lot of time. We're working closely with the other company that's actively in TDAPA, Akebia. We've been compounding the payment on the Hill, as well as with career staff at CMS, political appointed staff at CMS. We've got a large number of co-sponsors of the bill. Now, timing is tricky, right? Because this likely needs to be attached to another piece of legislation. There's a war in the Middle East. So we really can't speculate on whether this can happen before June 30th or December 31st.
This guy's pretty
recent. I think if it happens after June 30th, I think there is a pathway for potential retroactivity of some aspects of the bill to impact positively on DefenCath. So that's something we'd actively be working on as well behind the scenes. But it's really hard to kind of pinpoint a timing with everything that's going on in Washington right now. With respect to the other LDO, I can't comment on ongoing discussions with customers.
They kept it. Well, yeah.
And your next question comes from Serge Belanger with Needham & Company. Please go ahead.
Hey, good morning. This is John on for Serge today. One on DefenCath and then another one on the Melinta product portfolio. So first, just curious if you have any updates on the inpatient opportunity with DefenCath. Have the sizes of the current contributions been growing, and just curious what growth profile you see from this segment in 26 and 27. And then on the Melinta portfolio, you mentioned Minocin and Vabomere being potential significant contributors along with RESEO. Curious if there's anything promotionally sensitive that you could kind of reinforce into these products to see some growth in the future. Thanks.
All right, thanks, John. And I'm not sure I fully understood your DefenCath question, but what I'll kind of touch on is our guidance and how we constructed our guidance for 26 and 27. So the way we looked at 2026, obviously with the way CMS did the calculation for the bundle adjustment, the $2.37 that goes into the bundle for the third and fourth quarter, it doesn't fully reimburse providers, right, based on current utilization rates. They used an older period of time to do that calculation that was based on our first year of launch. But we had provisions in our agreements with customers that allow for that type of situation where there's certain floor pricing under these contracts. What we're working on now is hopefully getting a little bit better than that floor pricing. But our guidance was somewhat based on the floor, right? And we're working through that process now. Now for 2027, what we wanted to do was give investors comfort that there's at least a base business level of DefenCath for which we expect to see price appreciation and hopefully stable volumes based on what we're doing now in the outpatient hemodialysis sector to kind of steady the market with customers. Now, we elected not to include in that 2027 guidance potential upside from what we're trying to do with Medicare Advantage contracting, with a potential new customers, both in outpatient hemodialysis and on the inpatient side, because when it comes to a guidance, it's very difficult, right, to guide towards something that is still under the way in terms of execution, right? So as we progress throughout the year, and should we get a Medicare Advantage contract across the goal line, and we have the ability to look and make a forecast around volumes, we would update our guidance accordingly as we progress through the year. On the Melinta portfolio question, look, I think Minocin and Vabomere are two really good, durable products that have entrenched utilizations in the hospital inpatient segment for treatments of niche infections, right? I think Minocin is closing in on around $50 million in sales. Vabomere is just under 30. So we do have a little bit of promotional efforts on there. We don't think that they are hugely promotionally sensitive the way a launch product would be, but we think there's a couple percentage points of growth there that we expect to get this year.
That's helpful. Thanks.
And your next question comes from Brandon Folkes with H.C. Wainwright. Please go ahead.
Hi, thanks for taking my questions and congrats on the quarter. Maybe just two from me. Firstly, on DefenCath, can you just talk about the customer mix currently and whether you anticipate any change of that in your 2026 and 2027 guidance? How should we think about the opportunity in the other mid-sized operators for DefenCath?
So right now, I'd say we're fairly heavily concentrated volume-wise with one of the LDOs, and then two of the three mid-sized players are driving probably 90-something% of our volume amongst the three of them. There's a third mid-sized provider that's utilizing, but not at the scale of others. And then we have a number of small accounts that even if they're utilizing it fairly broadly, they don't represent as large of a market impact because they may only have 20 clinics or 15 clinics. So that's certainly kind of the mix today. Now, in terms of changes we would anticipate in 26 and 27, right, would depend in large extent to our ability to onboard either the other LDO or to get the third mid-sized player to meaningfully increase volume. So these are the only things that would really kind of, I'd say, change the mix in any meaningful fashion. What we're doing on the inpatient side in terms of promoting DefenCath, while that's a good dollar market opportunity, we believe the volumes there would be much lower, right, from a volume distribution standpoint. So I hope that answers the question.
That does. And if I just may ask one more.
All right.
I know you mentioned you filed the 10K. Sorry, I haven't been through it. But so can you just talk about the operating cash flow in the quarter? It looked very strong. So just, anything to consider there, and then also maybe how we should think about it in 2026. Thank you.
Yeah. Look, I think roughly, we like to say that the EBITDA is could be a proxy for cash flow for the year. I think there's some items that could impact in terms of our need to maybe stockpile some inventory this year as we're working through a few tech transfers. We also have some rebates large accrued rebates that you'll see on the balance sheet that'll get paid out in the early part of this year. So, yeah, those are kind of really the big items that impact cash flow. Susan, anything you want to add to that?
No, you covered it, Joe.
64 employees.
Great, thanks very much.
People are small. New Jersey.
This concludes our question and answer session.
All right.
Okay.
Today's conference call.
Hopefully that helps.
Thank you for
All right,
attending
guys.
today's
That was
presentation.
great.
You may now disconnect.
Yeah, that calls an end to this. Oh, look at this guy. Well, okay. So, just to kind of sum it up at the end, which was a pretty well-rounded episode in just looking at this company specifically. Looks good. I like it in all regards. There's definitely the risk, that it's basically, but it seems like, well priced into it. Even the fact that management is buying back the stock, the fact that all analysts are giving a strong buy with 100% upside. It's just all like the margin of safety is good. We talked about how the drug itself, whatever system for the IV that they use, for the catheter, sorry, it's strong. So yeah, so it all points to the fact that yes, they will get hit in terms of price and maybe even a little bit of volume once the TDAPA phases out. But they seem prepared for it. It seems a more relevant and more impactful solution than what we saw with the calcium mimetics. So, yeah, I feel like the risk is well priced in at this current price. And everything points to the upside there's no, the downside, it's like, how would I say it? It wouldn't translate yet. Is what I think will make the most sense here. Like, even if they don't perform as well, which it doesn't really, everything points to the opposite. Like, the revenue is gonna get lower than this year, but just because they have to adjust all of pricing. Like, this was a very good revenue year, but it's kind of like that allows them to grow within the market, which is why I also like that they acquired this company now, that they know all this money that is coming in is going to go away. Not because the customers are going to go away, and that's what we got to see, if the discount and the contracting that they do reflects that. But because, the price it was just paid by Medicare, by CMS, so now they will have to take some of that cost so that the customer doesn't have to. CMS seems aligned with the regulations that we've seen that they've changed, or how they analyze the add-on, and it's annoying that it's slow, that only once a year. That is annoying. But since they seem to be responsive about the fact, and this is a very impactful change because it allows for CMS and Medicare to reduce cost because they will have less hospitalizations because they have less infections. It seems to me like they will be more proactive about it. But even if they don't, even if they're not, we'll be fine. And that's also like what he was pointing out a little bit, even beyond that, because he's saying, the add-on calculations were using the utilization rates from this past year, not the current ones, which are much higher, much different, right? So that should affect the add-on going into 2027, which allows them to charge a higher price, which is going to be good. So now it is a longer bet in the sense like, even if things turn out good or even great, we won't see them playing out until 2027 or, like until the end of 2020. They probably will start seeing a catalyst, at the end of Q3 of 26. But anyway, that wraps it up for today. Thank you for being here. Let me know what you think of this company. And I like this episode. It's slower in the sense like we're not looking at many companies, but it's an interesting one. It's good that we look at it in more depth. So thank you for watching, and please like if you like the video, and subscribe if you want to see more. Let us know what you think, and share the video with other people. Thank you, everybody. God bless you.